Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies and study how they actually work, piece by piece. Today we're looking at an expert advisor for MetaTrader 5 called Broken Leg Trap Reversal. It's a trend continuation strategy built around market structure, swing pivots, a moving average trend filter, and an average true range stop. Over the next few minutes, you'll learn how it defines a trend, how it spots a failed breakdown, and how it manages its stop and its target. This is educational content only, so let's dig in. So what does this expert advisor actually do? Broken Leg Trap Reversal is a trend continuation strategy. The core idea comes from the way price tends to move in a trend, not in a straight line, but in a series of legs separated by swing highs and swing lows. Every so often, a corrective pullback pushes past one of those protective swings, reaching the resting orders just beyond it. And for a moment, it looks as though the trend is over. But if price quickly closes back onto the trend side, that break was false, a trap for traders who committed to the reversal too early. This strategy is designed to detect that failed break and rejoin the dominant trend as it resumes. To do that, the expert advisor combines three simple tools. First, fractal swing detection finds the recent swing highs and lows, using a lookback of 3 bars on each side. Second, an exponential moving average, with a default period of 50, acts as a trend filter. The strategy only looks for long setups when price is above a rising average, and short setups when price is below a falling one. Third, the average true range, with a period of 14, measures volatility and sets the distance of the protective stop. It runs on a single primary time frame, and it makes one decision per completed bar, so it isn't reacting to every tick of noise. This kind of approach tends to suit traders who think in terms of structure and trend, and who are comfortable waiting for a specific pattern to form rather than trading constantly. As always, this is a study of how the code behaves, not a recommendation, and not a promise of any particular outcome. Trading carries risk, and losses are part of it. Let's walk through the exact logic, step by step. Everything begins with the trend filter. On each newly closed bar, the strategy reads the exponential moving average and compares it to the previous bar's value. It calls the market an uptrend when the closing price is above the average and the average itself is rising. It calls it a downtrend when price is below the average and the average is falling. If neither is true, the strategy simply waits. Alongside that, the expert advisor is continuously mapping structure. Using its fractal method, it confirms a swing low or a swing high once a pivot bar has the required number of bars on each side that are higher or lower than it. That confirmed swing becomes the protective level the strategy watches. Now the setup. Consider the long side in an uptrend. The strategy waits for a pullback whose low pierces below the most recent swing low and, importantly, also closes below it. That combination, pierced and still below at the close, is what the strategy treats as a broken leg. It arms the setup, records the lowest point of that break as the trap extreme, and starts a countdown. From there, one of two things happens. If price closes back above the broken swing level within the reclaim window, 3 bars by default, the break is judged false, the trap is sprung, and the strategy enters long to rejoin the uptrend. If that reclaim never comes and the window expires, the strategy stands down and treats the move as a genuine breakdown. It also refuses to rearm on the very same swing twice. The short side is the mirror image. In a downtrend, the strategy waits for a bounce whose high pierces above the most recent swing high and closes above it, records that trap extreme, and watches for price to close back below the level within the reclaim window. If it does, the strategy enters short. Risk management is defined at entry. For a long, the stop is parked below the trap's lowest point, offset by the average true range multiplied by its multiplier, which defaults to 1. The distance from entry down to that stop is the risk, and the take profit is placed at a reward multiple of that risk, 2 times, by default, giving a 2-to-1 reward to risk structure. The short side mirrors it, with the stop above the trap high. Only one position is held at a time. Here's the heart of the expert advisor as it appears in MetaEditor. At the top are the inputs, the values you can adjust before running it. You can see the swing lookback of 3, the trend average period of 50, the reclaim window of 3 bars, the average true range period of 14, the the stop multiplier of 1, and the reward multiple of 2, along with the fixed lot size and the magic number that tags its trades. Below that are the two signal blocks. Look at the long block first. The first condition arms the setup. There's no long already active. A swing low has been confirmed. The trend filter reads up, and the bar has both dipped below the swing low and closed below it, the broken leg. The strategy stores the trap low and the broken level. The second branch is the entry. Once active, if a later bar closes back above that broken level, the reclaim is confirmed. The stop is set below the trap low using the average true range. The take profit is set at the reward multiple of the risk, and trade.by places the order. The short block is the exact mirror. It arms when there's no short active, a swing high is confirmed, the trend reads down, and the bar pierces above the swing high and closes above it. When a later bar closes back below that level, the stop is placed above the trap high, the take profit at the reward multiple of the risk, and trade.sell places the order. Notice both sides carry a stop and a target from the moment they enter. Let's bring the logic to life on this illustrative chart. On the left, price is climbing in a clean uptrend, and the blue line running beneath the candles is our exponential moving average, sloping upward. Because price is above a rising average, the strategy's trend filter reads up, so it's only interested in long setups for now. As price advances, it leaves behind a swing low, the dashed green line marked prior swing low at 1.0830. That level is the last protective floor of the current leg. Watch what happens next. Price stalls and pulls back, and one of these candles drives its low down through that swing low and closes beneath it. On its own, that looks bearish. It's the kind of move that convinces counter-trend traders the floor has given way, as price reaches the resting orders just below the swing. But notice the average is still rising, and price is still within the broader uptrend. The strategy doesn't chase the breakdown. Instead, it marks this as a broken leg, records the fresh low as the trap extreme, and starts its reclaim countdown. Now the trap springs. On the very next candle, price snaps back and closes above the swing low again, back on the trend side, while inside the reclaim window of 3 bars. That reclaim is the signal, and the buy entry marker prints right here. The protective stop sits just below the trap's lowest point, offset by 1 average true range. So if the breakdown had been real, the loss would have been contained. From the entry, the distance down to that stop is 1 unit of risk, and the target is placed 2 units above, that 2-to-1 reward to risk you set with the reward multiple. Price pushes higher, leg by leg, and reaches the take profit marker, closing the long. Now the market rolls over, and watch the average. Price tops out, turns down, and slides below the blue line, which begins to slope lower. The trend filter now reads down, so the strategy shifts its attention to short setups only. On the way down, price carves out a lower swing high, the dashed red line marked prior swing high at 1.0856. This is the mirror image of what we just saw. A corrective bounce lifts price back up, and one candle pushes its high above that swing high and closes above it. To breakout buyers, it looks like the downtrend is finished, and price has reached the orders resting above the swing. But the average is above price and sloping down. The broader trend is still lower. So the strategy tags this as a broken leg on the short side, records the trap high, and starts its countdown. Then the reclaim. The next candle closes back below the swing high, back on the trend side within the window. The sell entry marker prints, and the protective stop is parked just above the trap high, offset by the average true range. The risk is the distance up to that stop, and the target sits 2 times that distance below. Price falls away and reaches the take profit marker, closing the short. So across both trades, the pattern is identical. A swing is pierced, the break fails, price reclaims the level, and the strategy joins the direction the trend was already heading, with a stop beyond the trap and a target at a fixed reward multiple. That symmetry is the whole idea behind broken leg trap reversal. That's the broken leg trap reversal expert advisor, from top to bottom. We covered the idea of a failed breakdown inside a trend, the 3 tools it leans on, fractal swings, an exponential moving average trend filter, and an average true range stop, the exact long and short conditions, the code that carries them out, and a candle-by-candle look at both trades. Remember, Everything here is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy has losing trades, and no pattern works every time. So study it, test it carefully on your own, and manage your risk. If you found this useful, please like the video, leave a comment with the strategy you'd like to see next, and subscribe for more MT5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.